is going to be Pradeep Kesavan from Elara Capital, one of the brokers that we use as part of our for the India Avenue Equity Fund. Pradeep has got an extensive experience as a strategist with Elara Capital, which is one of India's strongly growing boutique equity firms. So without further ado, I'll pass it over to Pradeep to discuss, so far we've learned about the manufacturing opportunity and the potential of it, but it's always good to tie that into how do you play this thematic and what are the valuations associated with the thematic. So over to you, Pradeep.
Sure. Thank you so much, Siva. So first up, my apologies. I've logged in from two different accounts, primarily because I'm going to present from my laptop in which the camera has been disabled. So I'm just going to do my intro on my phone and switch this off, switch out to my laptop for the presentation. So my name is Pradeep Kumar Kesavan, and I'm the equity strategist with Elara Capital. I've got a background in both public and private market investments. Prior to Elara, I've been with firms like Morgan Stanley and Accenture Strategy and Strategy Consulting. I have been working in these fields for close to about 17 years now. So with that as a brief introduction, let me just switch over to my laptop to share my screen where I have a presentation to share with you today.
Hi, Pradeep. We're not able to hear you. Would you be able to unmute yourself? Hi, Pradeep. We still can't hear you.
My apologies.
Okay, that's fine. It's working.
Am I audible better now?
Yes, that's fine.
Siva, am I audible?
Yes, you are. Please go ahead.
Awesome. Yeah. Thank you. So I was talking about taking a snapshot of where we are in point number 2 in terms of the catalyst before going into the key sectoral beneficiaries in terms of where we can play, and that's where we'll probably briefly talk about what the competitive advantages of those industries are and where we stand in terms of valuation. So if you were to take a snapshot of where we are and then look at top 200 companies that are listed in India, which will probably capture a overwhelming majority of about 90% or so of the market capitalization, and then broadly segregate that into companies that fall under manufacturing and the companies that are non-manufacturing. Two things will come out very clearly. The first is on the data that you're seeing in front of you is a 10-year average. So we are looking at a long period of time, capturing a cycle or so. What stands out is you will notice that when we talk about growth, of course, India has been a fairly strong growth market, and we are talking about a set of companies which have been the most successful in the listed space. So we definitely will have a healthy number to look at here. And one thing that strikes is there isn't too much of a gap, so to speak, between what the manufacturing companies have delivered versus the overall universe of non-manufacturing companies, although there is a bit of a gap. That's not too much pronounced. But the real issue vis-a-vis manufacturing actually starts when you look at the returns that these companies have generated for investors over a period of time. That's when you look at it from a return on equity or a return on capital employed standpoint, you will notice that the gap actually widens pretty strongly. The non-manufacturing companies have delivered far better returns. And most importantly, when we have this return discussion, we should also probably have in mind the cost of capital at the hurdle rate over and above which the companies have to deliver to generate shareholder value. Now, so from that standpoint, if you see on an average in the last 10 years, a typical manufacturing company has not had great success, if you will, in terms of delivering shareholder value, because the cost of capital or cost of equity for a market like India has been a healthy double-digit number. So the rough cut cost of capital number that we use is somewhere around 12%, and the cost of equity is 13 to 14%. From that standpoint, you'll notice that mostly on an average, manufacturing has been shared as well in the last 10 years. But having said that, as I said before, there are great exceptional stories and there are not so good stories inside this. Now, we'll come to that when we dissect that sector by sector to understand where the opportunities could lie. So what it translates into is if you look at the performance of these companies and therefore the representation of those sectors in the index, the primary index, which is Nifty in India's case, you will realize that the result of what we saw in the last slide is actually starting to show up in terms of manufacturing oriented sectors starting to lose weight over a period of time. So up until year 2015 or so, you'll notice that there have been a strong presence of a lot of manufacturing companies. So a lot of discretionary will include auto components, consumer durables, etc. Similarly, healthcare was a fairly good manufacturing story in pharmaceutical space, industrial companies, and materials, right? So we've had a strong presence back then, but over the last 5 years, you'll notice that the share of manufacturing in the index weight has been losing, and then not least because that manufacturing story has not been as great in terms of delivering superior returns. And there are several structural issues that also came in terms of firms getting excess leverage, etc. So many of that right now are being addressed, and many of that are getting addressed structurally by way of reforms. Many of that are being addressed a little more on an idiosyncratic basis by some of the companies that actually couldn't do very well. So the bottom chart actually shows that if you rebase the indices back to 2003 and then track the trajectory of how manufacturing weights have fared over the last 15 years or so versus how the non-manufacturing weights have fared, you'll realize that that not just in the last 5 years there has been a sharp decline in manufacturing, but one bit of a turning point happened in March 2020 when the markets kind of went into one extreme levels of negative sentiment driving because of the COVID pandemic, post which in the resurgent market that we're seeing in the last 6 months or so, manufacturing actually is starting to gain weight. So primarily, some of the sectors and some of the themes that we're going to discuss is also playing a part in that. And what we've traditionally also seen is every market shake-up, a major market issue, like the 2008 great financial crisis, or if you go back to 2000 in terms of the dot-com bubble, etc. Typically, markets have used those events as a reset to look at a new emerging new theme to run for the next 5, 8, 10 years. So from that standpoint, we do believe there are reasons to believe that the COVID-related reset that has happened in the last 6 months in the market is going to give us a newer base from which there will be newer themes and stories that will emerge. And that's the trend that you're seeing on the bottom could be a very, very nascent early sign of that. So finally, how does it all play out in terms of the valuations of these sectors? So when it comes to valuations, our preferred way of looking how a company is valued is to look at first look at the market and take the market, because market price has so much information going into that. So we usually prefer to leverage or re-engineer the price and take a second guess as to what the market is assuming in terms of price performance and therefore the valuation of a company, sector, or a store, or the index itself. So the way we look at it is we split the company's share price or a valuation into 3 broad categories in terms of what a company's value should be for its core operation as it stands today, which is what is depicted in the darker blues on the left-hand side charts, both bottom and top. And what is it that an investor can expect in terms of the value explained by the immediate growth prospects of the company, which could be the next 2 years, 3 years. And therefore, what is the value that the company has to go about realizing in rest of its life to perpetuity? So that's the lightest blue bar that you see. So we call them the long-term growth value, therefore the LTGV denotion that you're seeing in the chart. So what are the advantages of looking at the valuation in this fashion is like it captures excess valuation very clearly when the long-term growth values shoot far too much. We know that there's a lot of speculation and too much of betting into foreign future earnings that's happening. But we also can look at how historically a trend has been in terms of how much an investor is typically willing to bet on a sector or a company's ability to deliver on its promise for future growth and earnings. So that combination of these two kind of gives us a good measure of how attractively or not so attractively a company or a sector is valued. So with that framework, if you were to look at how manufacturing companies versus non-manufacturing have fared over the period of time, on the left-hand side are the charts which depict this dissection over the last 7 or 8 years. You will notice that there is no surprise in the sense that investors on an average have been more willing to bet a little more for long-term growth from non-manufacturing companies as compared to manufacturing, especially in the last 4 or 5 years, which is in sync with also the trend that we saw in terms of how manufacturing has been losing weight in the index itself. That's again a sign that the investors are a little more focused on non-manufacturing companies and sectors, whereas against manufacturing. But if you take a snapshot on the right-hand two charts of what the long-term attribution alone and how does that compare to historical levels, what this data point shows us is at present condition, are investors willing to bet a little more on a particular stock or a sector compared to how exuberant or how positive they were in a particular sector in the past. So from that standpoint, you will notice that manufacturing, after the strong fall that we saw in March 2020 because of COVID, where there was a sharp shrinkage in both manufacturing as well as non-manufacturing valuations, there has been a healthy increase in the manufacturing long-term growth attributions, much more even than the non-manufacturing sectors that you're seeing. And in the process, what we're also seeing is the investor confidence level and therefore the willingness to attribute a little more to longer term value has strongly improved, and it's improved beyond the last, the average that we've seen over the last 10 years or so. So that again is an emerging sign for us that things are kind of turning in favor of the manufacturing story here and re-emergence of manufacturing. So that's a bit of history in terms of what manufacturing was in terms of growth, in terms of returns, what kind of place does it hold in the index constituency, and where do the valuation, what do investor confidence tell us. With that as a background, in the next section, we'll talk about where we are and what are the key catalysts that could provide a little bit more of an impetus to manufacturing as a sector as we look forward. Of course, the idea here is not to drain the slide, because I'm sure in the last two sessions, especially the previous session, you would have had a great insight as to what are the new initiatives by the government, what are the things that you can look forward to in terms of impact from those initiatives, and how it's going to affect various sectors within manufacturing. The only thing that I would probably add here is when we look at the catalyst, either from a government incentive or initiative standpoint, or from any structural change that we're looking at, we need to look at it from two perspectives. Oftentimes we notice that there's a lot of emphasis that goes into what could be the potential of new and emerging areas that can actually benefit from this kind of a trend, which is of course great to focus on. But when we also look at it from a public equity investment standpoint, we need to also be cognizant of the fact that there could be existing bigger manufacturing stories that can also gain traction because of some of these initiatives. So from that perspective, beyond this slide, whatever we are going to talk about sectors, the approach that we have taken is the sectors that are likely to benefit due to these incentives and impetus, which could already be in play, or it could also be a little bit on the emerging side. With that as a small background, so some of the things that could definitely have a bit of rub off, I'm sure it was covered in the past session as well, is there's been a very significant government target in terms of having manufacturing as a $1 trillion activity by 2025. Whether or not we go about fully achieving it or not is another question, but then the path to that has been clearly laid out. Whether we achieve 100%, 80%, 70% remains to be seen. But to my mind, some of the reason, there are several government initiatives that have come in, but if we were to call out some of the most important ones from the investor standpoint, which will help us zero in on opportunities. One major one has been the tax reform that has already been announced, wherein corporate taxes have been reduced, which is going to be a great incentive for existing players as well as for new players that are going to enter into this sector. The second one is in terms of the enabling investment into the infrastructure activities. So there is a national infrastructure pipeline that was announced to the tune of about $1.4 trillion US, which will primarily focus on enabling infrastructure. So what this is going to do is it's going to enhance logistics and supply chain efficiencies for all the players. It will also provide a great incentive for new players to come in. So those are some of the major ones that we are actually looking forward to translating into action on the ground. While the other one, in terms of a geopolitical and geostrategic implication that has gained traction in the last, actually been in vogue for the last 2 to 3 years with the US-China trade war, got a little bit more of catalyst with the COVID-19 pandemic, where people got acutely aware of over-dependence of supply from a particular country. So that's something that's going to drive a lot of shift away from supply chain, from China centricity, away from China into some of the emerging economies. And when we talk about emerging economies in this context, it's worth pointing out that the opportunity will not be exclusively India's, of course, but what India has to offer in many of these spaces that we are going to discuss is by itself a large market as compared to the rest of the competing emerging countries that are also trying to take a pie out of China's share of manufacturing. So if you look at leading players there like Vietnam, etc., as compared to some of the Vietnam and other Southeast Asian countries, in many of the areas where India's kind of increasing its focus, you will notice that Indian market itself is a huge enough market for somebody to get incentivized to come and address that. So one of the reasons why we believe some of the new investments that you're seeing in electronic manufacturing, etc., that we've seen in terms of announcements, is also partly due to the fact that there is a huge addressable market domestically. So there will be two portions for manufacturing, if you were to talk about it. One is manufacturing in India for India, and manufacturing in India for the rest of the globe. So from that standpoint, so this is an important area that that comes to fore. And lastly, of course, there's also the structural element of labor force and skill levels being available for many of those sectors. So here, it's again, our experience has been not uniform across all sectors. There are better sectors that could definitely gain a little more. And there is a lot of distance that need to be covered when it comes to skilling the general level of workforce. But the wage disparity definitely continues. So India continues to take the advantage of the labor force economy. But what remains to be seen is the advantage that is there in terms of wage cost, adjusted for productivity does stand out. So that productivity adjusted labor cost advantage holds for certain sectors alone. So that is where we are in terms of how the new initiatives that have been announced in the last few months, in terms of what is it that's going to help us. We'll use this as a prism to look through in the future for the sectors that we probably could benefit from. So I'm moving on to my last section, and we'll look at a few sectors which we believe can definitely benefit from this, post which of course they can take questions. So the first one in terms of from a public investment standpoint is automobile. Again, just to go back to my point that when we talk about manufacturing, we should be also aware of the fact that the existing setup and existing investment universe needs to again need to be considered before we look at the new emerging areas. From that standpoint, automobile, both auto OEMs as well as auto components, is probably the biggest manufacturing activity in the country today. So which kind of accounts for more than 50% of our overall manufacturing output. And by all accounts, we believe that the strength of automobile as an industry and the contribution to manufacturing will continue to be strong on two counts. One is, this is again one of those sectors which greatly benefit from India itself possessing a large enough domestic market to address from an OEM standpoint. And we are looking at a market which is like close to 20 million two-wheelers and about 3 million four-wheelers, even after the depressed demand that we saw in the last year because of lockdowns, etc. And this is again a sector which has in the past developed strong cost competitiveness and fairly high amount of expertise in labor-intensive areas where, especially in the lower level auto component and auto ancillary sectors. So we have in auto sector, which is kind of can play both the elements of manufacturing as far as India is concerned, wherein we can talk about an Indian market as well as manufacturing in India for global markets. So far, so if you look at the auto sector in India, so you'll realize that the original equipment manufacturers are largely domestic market focused with limited exports, whereas the ancillaries are a lot more export focused. So you have the dual play of domestic as well as the export angle as well as autos are concerned. And if you were to look at where the potential of this sector is over the near term, and then therefore where how we read the valuation, you'll realize that the near term sales. I think in previous presentation also we saw that the auto has been one of the badly affected sectors in terms of its sales and therefore current production. But so therefore, it kind of necessitates that we look at it more from structural next 3-5 year plus kind of time frame. But if you were to just take a sneak peek of what we're likely to look at there in the next 2 to 3 years, this is a sector where both in terms of top line as well as bottom line, the traction is going to be very heavy. This is a sector which will probably grow marginally above the GDP rate of the country. Definitely, it will continue to do so. And within that, the outlook has been pretty strong for passenger vehicles as far as domestic market is concerned, and increasingly with improved economic activity and the infrastructure related thrust, you will notice that the commercial vehicle play will also come back into the sector. So from a fundamental standpoint, we have from a top line perspective, from an operational improvement perspective, as well as from an improvement in return on equities, there is fair amount of room structurally if you were to look at it. And then we need to also keep in mind that auto is a fairly well advanced manufacturing capability as far as Indian auto manufacturing is concerned. And these are companies which have had a strong past record of delivering shareholder value and therefore high levels of ROE. So what you're seeing on top chart here is just the improvement in these metrics that we're anticipating. Of course, you can look at an exaggerated improvement in the bottom line in terms of profit after taxes. That's primarily because the last year has been pretty bad. But even if you were to adjust for the fact that number is expected to be about 50-60%, but if you adjust for the fact that even in a normal course, we are looking at something like a healthy double-digit growth in bottom line and a high single-digit to a potentially double-digit in the near term in top line, and things to improve from there on. So that's most important sector that will continue, in our view, to be relevant from an investment standpoint. And if you were to look at from a valuations, you'll realize that the rightmost bar chart that we have has got a very minimal element of value attribution for the company's core businesses today. Again, a reflection of the fact that the last year has been a really bad year for all the auto companies in India. But what it has resulted is a sharp turnaround being forecast for the next couple of years, which is also kind of reflective of this sharp growth that we're seeing in terms of profit, beyond which also the confidence continues to be high. So this is one of those sectors where the investors continue to hold their faith in terms of companies' ability to deliver not just near-term earnings, but also in the long term. So that's one sector that will be of greater importance in Indian manufacturing play. And the second one, which is now gaining traction, is the chemical broadly, but within that agrochemicals, if you get things have changed in this industry. Once the last 2 to 3 years, this is a sector that has kind of gained a lot of prominence because of to start with, because of environmental issues that started in China, environment norms being a lot more stringent, because of which some of the capacity started shifting towards India, some of the demand started shifting towards India, which Indian players were pretty well positioned to cater to. So that's a major theme that was playing in the last 2 to 3 years. But if we were to look at it from the current scenario, again, this is likely to be a sector which will benefit from the global supply chain diversification away from China, definitely. And the other trend that we have recently been noticing is globally there is a lot of cost consciousness that's going in this sector in terms of end use consumers being more cost conscious and therefore shifting more and more to generic chemicals, agrochemicals as against patented molecules. So that again is a key benefit for Indian players here. And this is again a fairly well advanced sector where India continues to enjoy relative advantage vis-a-vis the rest of the competition there. And if we were to also talk about the domestic policy, so you'll also recollect that the government has sort of unhinged the agricultural sector away from a lot of restrictions that have been posted. So all the agricultural experts that we've been interacting with have been equating the current agricultural reforms, if you will, in line with the overall economic reforms that India unleashed back in 1991. something of similar nature has been done for agriculture sector. So right now, you'll probably see a lot more plays coming out of agriculture broadly, although my slide talks only about the agrochemical part, which will be a key beneficiary of the initiative, but there'll be several offshoots to that initiative, in the government initiative in terms of agri-related investments and therefore manufacturing, food processing, warehousing, cold chain, etc. So that's something that will definitely play out. But when we look at it again from the prism only of equity investment in public space, agrochemical will be a key beneficiary of that, because most of the emerging areas in cold chain technologies and food processing, etc., will come in, but how much of that will percolate into public investment opportunities remains to be seen at this stage. The third one we'd like to highlight is the pharmaceutical sector. Again, just like agrochemical, this will be a sector which will benefit from the recent the COVID-related pandemic impact on two counts. One is more in the near term. We are noticing that India, being a major pharmaceutical player, getting a lot more benign view from some of the key export markets like the US, because globally there's an environment of higher consumption orientation towards pharmaceutical drugs, and therefore some of the drugs that were in the pipeline which got hindered due to US FDA approvals not being coming on time, etc. So those kind of issues are now getting cleared in a much more accelerated fashion. So that's more like a very near-term trigger for the sector. And that near-term trigger is actually translating into a very strong fundamental numbers over the next 2 years. If you were to look at the next 2 to 3 years, healthcare today, the pharmaceutical specifically, is one of the highest or the best, I've got the best indicators across top line, operating line, as well as bottom line expansion, translating all the way down to best improvements in return on equity for investors. So that is something that that's the sector that's got an immediate play in our view. And again, if you were to look at from the sector's position in the index, you'll notice that this is one of those sectors which has contributed currently, if you see, it's contributing a lot more in terms of the profit pools of the index than it has got credit for in terms of the weight in the index. So there is a bit of an anomaly in terms of pharmaceutical companies contributing a lot more profits, but getting a lot less weight. So we expect that that to be a major trigger and a driver to get a lot more investor attention here, and therefore a better potential for our performance in the future. We are already seeing that post March, pharmaceuticals have been one of the better performing sectors in the country, but that outperformance in our view will continue. Again, if you were to look at it from the valuation standpoint, you will notice that the healthy amount of value is being attributed for what can be achieved in the next 2 years, again reflective of the fact that there is a sharp improvements all around in the sector, and also from kind of shaking away from lack of confidence that you would have seen here. The investors again willing to bet a little bit more long term in terms of long term value attributions increasing. This is a sector where there's a lot of headroom for outperformance. The next one, which is worth highlighting, is capital goods and defense. Again, this is one area which will be a key beneficiary of the recent government policies in terms of the Self-Reliant India initiative. That's largely focused on strategic sectors. Defense being one of those will be a major beneficiary. And again, as I mentioned before, the national infrastructure policy of about $1.5 trillion US, that again is a major impetus that's going to come for the capital goods players as well. So
Pradeep, just a quick one. We probably have about a minute or so. Is it okay if you can wrap up in that time?
Yes, yeah. I'm into my last sector, so I'm almost done there. Yeah. Okay, so that's again in that sense sector that's to look out for. Again, here the only point that's worth highlighting is emerging areas like lithium cell and energy storage, etc. So that will again continue to drive this sector. The last sector I had in mind was consumer durables and electronic manufacturing. Here, it's again a combination of two things. So the primary driver here in this industry continues to be the large market that India itself is. And this is one of the focus areas where the government is working on a focused manner, giving incentives to companies to the tune of 4 to 6% for players who are going to come in and set up new manufacturing capacities here. This is part of the reason why you are seeing the Apple and a lot of new electronic manufacturers coming in setting up. And the offshoot of that will be the electronic manufacturing outsourcing, which has got only two players listed in this space, Amber and Dixon Technologies. We probably will see a lot more growth. So again, as you can see from the fundamental trajectory, this is a sector which is poised to kind of grow pretty strongly, and in terms of valuation looks well positioned. So I'll stop there, and if there are any questions, happy to take.
Yeah, what we'll do with the questions is we will forward them through to you, given that we've gone past the time a little bit. So I will organize for any questions to come through to me to be emailed, and hopefully we can get a response from you that way, if that's okay.
Absolutely, happy to do that.
Thanks, Pradeep. We really